Welcome back, guys, to part 3 of the series here. And we're going to start to put things together here now. We're going to talk about how to optimally structure your tax entities so that we can reduce those taxes and keep more of your hard-earned money in your own pocket. Now, if you haven't watched the first 2 videos in this series, or you're not coming into this with a good understanding of the differences in legal and tax entity structures, as well as the difference in active and passive income, I highly recommend that you go back and watch those first 2 videos before you get into this one. Now, for me, I think the easiest way to understand this all is to start getting into some fun examples, right? So let's just dive in here. On the first example, let's assume you go and you buy a real estate investment property. And what I mean by a real estate investment property is a rental, a long-term or a short-term buy and hold. It can be a long-term, mid-term, short-term rental, but you buy something that you are going to hold and get rental income from. Then you go buy your property, right? Speak with an attorney at that point about how to ensure you get your property into the LLC so that it's protected. You are now set from a tax standpoint on this rental investment. If you own it by yourself, you are now considered an LLC disregarded entity, and those activities are going to go on the Schedule E of your personal tax return. If you own it with a partner, you are now considered an LLC partnership, and those activities are going to go on a separate partnership tax return, and then they're going to flow in to the Schedule E of your personal tax return. Now, what about setting up this LLC to be owned 50-50 or some other ownership percentage with your spouse? Well, I strongly recommend talking to an educated real estate attorney on whether you should do that or not. From a tax standpoint, you are likely going to open yourself up to having to file a separate partnership tax return, which now increases your compliance needs and accounting fees. So you just want to ensure that if you're doing that, there's a reason to do it. So we've got the LLC, disregarded entity, or the LLC partnership. Do we need an S corporation? And the answer is absolutely not. Do not put this real estate investment into an S corporation. In fact, you should almost never put a real estate investment into an S corporation. If you've watched our other videos, you'll know that real estate income is considered passive income and it's not subject to self-employment taxes. The point to setting up an S corp is to eliminate self-employment taxes. So when we're talking about rental investments, you have no self-employment taxes. Why would you be worried about eliminating self-employment taxes? Should you convert that LLC into an LLC C corporation? Again, absolutely not. A C corporation ends up having 2 potential layers of tax. It's called double taxation. And there are times when it makes sense to get an entity into a C corporation, but almost never will it make sense to put your real estate investments into a C corporation. Now you might be saying, what could it hurt? I already have an S corporation or a C corporation set up. I might as well just put everything into that. And without even getting into the legal aspects of that, let's talk about something called a step up in basis and how that's affected whether you're in an LLC disregarded entity or an LLC partnership versus an LLC S corporation or C corporation. If you bought this property for $300,000, you're going to depreciate it over time, and you end up holding this property for 30 years, or you exchange it and you end up holding other properties for 30 plus years. You're now an old man or an old woman. It's 30 years later, and this $300,000 property is probably well worth over $1 million. But on your books, it's at $0. You've depreciated the whole thing. If you go sell that property, you are going to pay capital gains tax on $1 million in gains. As of 2024, your capital gains tax would be calculated at 20% plus 3.8% for investment taxes and your state taxes. You're going to pay close to $300,000 in taxes on that. But if instead you die and that LLC investment property passes on to your heirs, on the day they get it, they get a step up in basis to the fair market value. Meaning if that property went from $300,000 to $1 million and it passes to your son or daughter, they get it for $1 million. They can sell it tomorrow for $1 million and they pay 0 taxes. Now, if this property was held within an S corporation or a C corporation and you pass away, nothing changes. The owner of the investment property did not change. It was not you. It was a separate business, an S corporation or a C corporation. So your daughter or son or your heir will take over this S corporation or the C corporation ownership, and they will have a property that's worth $0 on the books. Meaning if they go sell it for $1 million, they're paying that 20+% of capital gains tax. So let's talk about just a couple other minor items here. Do you need to take a salary from this LLC? No. If you want money out of the company that's an LLC and it's not an S corporation or a C corporation, You take that money out as distributions. It does not affect your taxes in general. It's not going to have any tax effect on you. So congratulations, you got your LLC set up for your investment properties, and that's how it will stay forever, barring a change in tax laws. So now let's talk about what a real estate investment is for tax purposes. A real estate investment is a buy and hold property. It's a long-term, a short-term, a mid-term rental. A real estate investment is not a flip. It's not wholesaling. It's not your realtor commissions or your property management. Those are all businesses. If you get into flipping houses, if you get into wholesaling, property management, coaching, realtor work, you have an active business and you have active income. And that is viewed entirely different than passive income. Remember, you now have federal taxes, state taxes, and potentially self-employment taxes. Now, if we change up the example and you're buying investment properties with another partner or owner, you have some different options as far as legal structures go. You can be an LLC, a limited partnership, a limited liability partnership, but the most common tends to be the LLC, and things are going to be the exact same as the example we just said. That's going to be an LLC partnership. It will have its own tax return to give you the K-1s that go on your personal return, but it won't be subject to self-employment taxes because it's not earned income. You will never make that into an S corporation, and you will never make that into a C corporation. If you die with that partnership interest that owns real estate investments, that interest is going to flow to your kids. They're on their share of what the real estate's worth. They're going to get a step up in basis from $0 or the amount that you've depreciated it down to all the way up to the fair market value of the property on that day. So we've ran through the examples of how you would structure your tax entities for passive investments and your rentals. And next, we're going to get into how we're going to structure things for your active income, those flips, that wholesaling, those commissions, whatever it is that you're getting into business-wise, that's going to have an entirely different structure than we've just talked about. Be sure to subscribe and catch the next video as we dive into structuring your active real estate.